All right, let's jump right into this explainer and deconstruct what is arguably the most famous misdeal in modern business history. We're going to conduct a sort of cinematic autopsy on the epic, heavily debated rivalry between Netflix and Blockbuster. Now, obviously, we all know how this story ends, right? One company became a massive global streaming titan, and the other, well, it's basically just a nostalgic memory. But the actual mechanics of how that happened go so much deeper than just a simple tech shift from physical DVDs to digital streaming. It's a wildly fascinating story, packed with missed opportunities, completely conflicting business models, and some serious boardroom drama.
To really wrap our heads around this, we actually need to rewind all the way back to the spring of 2000. The dot-com bubble was aggressively deflating, and this tiny, struggling DVD by mail service was just bleeding cash on postage and warehousing. So their co-founders, Reed Hastings and Mark Randolph, flew down to Dallas. They were desperately hoping to sell their little startup to the reigning, undisputed heavyweight champion of home entertainment, Blockbuster, for exactly $50 million. They even pitched a whole plan to run Blockbuster's online brand as a co-branded service. Well, as you might guess, the pitch did not exactly land. You have to remember, at this time, Blockbuster was operating nearly 8,000 stores and pulling in over $4 billion in annual revenue. They were huge. So Blockbuster's CEO, John Antioco, listens to the pitch, but according to what Netflix co-founder Mark Randolph later recalled, Antioco was literally struggling not to laugh. He just totally dismissed the idea as a very small niche business. And the Netflix team was politely, but very firmly shown the door in under an hour.
Section 1. Data flywheels versus late fees.
Now, with the benefit of hindsight, it is super easy to mock that rejection. But to understand why it was actually a completely rational decision for Blockbuster at the time, we have to look under the hood of both businesses. What was really driving their profits? We're looking at two totally different profit engines here. Blockbuster was incredibly reliant on late fees. In the year 2000 alone, they brought in $800 million just from late fees. That was roughly 16% of their total revenue. Netflix, on the flip side, charged a flat subscription with absolutely zero late fees. So acquiring Netflix wouldn't just mean buying a struggling startup, it would literally mean cannibalizing Blockbuster's most reliable cash cow. It's the classic innovator's dilemma. Quarterly investors would have demanded to know why leadership was intentionally destroying their own profit margins.
So while Blockbuster was handcuffed to those late fees, Netflix was quietly building a massive structural advantage under the radar. From day one, they engineered an analytics-driven growth flywheel. It all started with their Cinematch recommendation engine, which basically personalized content for every single user. That personalization drastically reduced subscriber churn. And, lower churn automatically means a much higher customer lifetime value. Those predictable, recurring cash flows eventually gave Netflix the exact capital they needed to aggressively expand their digital library and build out their streaming infrastructure.
The result of that flywheel was a completely massive divergence in annual churn rates. By leveraging all that behavioral data, Netflix systematically dropped their churn rate down to about 30% by 2010. Blockbuster, meanwhile, was still tracking legacy retail metrics, things like store traffic and rentals per outlet. Because they totally lacked predictive insights into shifting consumer behavior, when customers finally started migrating to digital, Blockbuster's churn rate absolutely skyrocketed. It hit a staggering 67% by 2010. Let that sink in. Nearly two-thirds of their online subscribers were just walking out the door every single year.
Section 2. Culture clash. Freedom versus process. What's wild is that this technological divide was actually born from a massive cultural divide regarding how each company handled talent and risk. After that failed Dallas meeting, Reed Hastings actually tried to recruit senior Blockbuster executives to bring some retail know-how over to Netflix. But literally nobody accepted. Leaving a multi-billion-dollar giant for a dot-com startup looked like pure career suicide back then. So Hastings pivoted. He targeted engineers and product managers who were totally comfortable betting their careers on uncertainty, while Blockbuster optimized for store EBITDA and managed everything through strict process manuals designed to minimize risk. Netflix was out there optimizing for subscriber satisfaction. They specifically hired unusually responsible risk-takers, fostering a culture that famously became known as freedom and responsibility. This created a workforce uniquely equipped to solve the really ambiguous problems of transitioning to digital, rather than just managing physical leases.
Section 3. Blockbuster Strikes Back. Okay, it is absolutely critical that we set the record straight on something right now. The myth that Blockbuster just blindly sat there and ignored the internet as it flew by is entirely false. Under CEO John Antioco, Blockbuster actually mounted a massive billion-dollar counterattack called Total Access. Antioco made the highly painful decision to drop in-store late fees entirely and launch Blockbuster Online. And the hook was brilliant. Rent a DVD online, return it in the store, and boom, get another movie for free. And guess what? It worked. By early 2007, the Total Access program surpassed 3 million subscribers. It was their highest growth quarter ever. It was so incredibly effective, and it cost Netflix so much momentum that a genuinely terrified Reed Hastings actually approached Antioco to propose yet another buyout, this time suggesting Netflix run Blockbuster's online business while Blockbuster handled the physical returns.
Section 4. The fatal boardroom coup.
But before that groundbreaking deal could ever see the light of day, Blockbuster ripped itself apart from the inside. The real death blow here didn't come from some Netflix algorithm, it came directly from Blockbuster's own boardroom. See, while Total Access was growing rapidly, it was also burning through a mountain of cash. Every free movie exchanged in store cost the company $2. This massive cash bleed, combined with the fact that Antioco had just received over $51 million in compensation for 2004, completely infuriated activist investor Carl Icahn. So Icahn launched a ruthless proxy fight. He fundamentally disagreed with Antioco's strategy of sacrificing short-term profitability to fund this digital internet war against Netflix.
Ultimately, Icahn won that proxy war. Antioco was pushed out in 2007, and his replacement, James Keyes, immediately reversed course. Keyes outright rejected Hastings' buyout proposal, and to protect the short-term profits of their physical stores, Keyes raised the price of online DVD rentals, ended the free movie deal, and reinstated late fees. In an instant, Blockbuster Online's massive, threatening growth was brought to a dead halt. The one single executive who was actually successfully fighting Netflix had been fired.
Section 5. The cost of hubris.
That singular boardroom reversal, choosing to prioritize physical store metrics over digital subscriber growth, really set the stage for one of the most brutal financial collapses in retail history. Blockbuster's revenue absolutely plummeted. They found themselves totally trapped by the inflexible overhead of 9,000 physical stores, massive debt from their previous ownership under Viacom, and a customer base that was absolutely furious over the return of those late fees. By 2010, groaning under nearly $1 billion in debt, Blockbuster officially filed for bankruptcy. Meanwhile, Netflix's recurring streaming revenues, fueled by that continuous, data-driven reinvestment flywheel we talked about, began an explosive and unstoppable upward trajectory.
The financial aftermath is truly staggering to look at. In 2011, Dish Network scooped up the remaining remnants of Blockbuster's empire at a liquidation sale for a mere $320 million. Contrast that with Netflix. Having completely and successfully transitioned to streaming and original content, Netflix grew into an absolute entertainment empire, valued by mid-2025 at $278 billion. That is more than 50 times the asking price that Reed Hastings was literally laughed at for in that Dallas conference room back in 2000.
You know, to this day, Netflix still keeps a framed photo of that Dallas meeting in their lobby in Los Gatos. It serves as a permanent reminder of a realization that John Antioco himself later acknowledged: legacy incentives can seriously cloud your judgment. It is a powerful reminder that smart, highly capable people sitting inside comfortable corporate castles very often completely miss the disruption, the catapult that is being built right outside their walls. So looking at your own industry or your own projects, you really have to ask yourself, what catapult is being built outside your comfortable castle right now? Think about that, and I'll see you in the next explainer.